Hey everyone, welcome back to The Explainer. Today we're diving deep into Viking Holdings Q2 2025 earnings. And let me tell you, it's a really interesting story of what happens when fantastic results run into a very skeptical market. So let's get right into it.
So get this. On the surface, Viking delivered everything you could possibly want to see. We're talking record revenue, bookings that are just completely off the charts. And what happens? The stock tanks over 6% at the open. So what on earth did the market see that the headlines missed? That's the big mystery we're going to unravel right now.
All right, so first things first. Let's look at the good news, because honestly, there was a lot of it. On paper, Viking's quarter was, well, it was nothing short of fantastic.
So Viking pulls in revenue of almost $1.9 billion. And this wasn't just a big number for the sake of being big. It represented over 18% growth from last year, and it blew past what analysts were expecting.
And what's really impressive is how that growth flowed right down to the bottom line. It's a perfect example of operational leverage. Their Adjusted EBITDA, that's a key metric for profitability. It shot up a massive 28.5% from last year. That shows you their margins are getting wider, which is exactly what you want to see. And then you get to the bottom line, adjusted earnings per share. That came in at 99 cents, which was exactly what Wall Street had penciled in. Just a solid, clean number. No surprises there, which is a good thing.
Okay, so let's just recap for a second. They smashed revenue estimates by a cool $50 million and hit their profit target right on the nose. This is what you'd call a classic beat and meet quarter, right? It's the kind of thing investors usually reward, big time.
But wait, it gets even better when you look at their future bookings. For 2025, they're basically sold out already. 96% of their spots are filled. And for 2026, a year and a half away, they're already over half full at 55%. That is just incredible forward visibility. It points to some seriously strong demand that just keeps on going.
Okay, so if everything looks so rosy, we're back to that same question. Why the heck did the stock drop? Well, to get that answer, we've got to dig a little deeper into that booking horizon. This is where the perfect picture gets, well, a little complicated.
And there it is. This is the one number, the one little detail that sent a chill down the market's spine. While the prices for their 2025 cruises were up a very healthy 7%, the prices they're getting for 2026 are up a more moderate 4%. Now don't get me wrong, prices are still going up, but the speed of those price hikes, that's what's slowing down.
And this quote from some of the analyst chatter really hits the nail on the head. Even with those amazing booking numbers, investors just completely zoomed in on this pricing cadence moderation. The fear isn't about today, it's about tomorrow. It's this nagging question of, has Viking hit its peak pricing power?
So, is that fear really justified? Well, to figure that out, we have to pull back from the quarterly numbers for a second and look at the bigger picture, the strategy that's guiding this whole ship.
It really all comes back to their CEO, Tor Hagen, and his very specific vision for the company. Viking is absolutely not trying to be a floating theme park for everybody. They're for a certain type of traveler. No kids, no casinos, no getting nickel and dime for everything. And that focus creates this incredibly strong premium brand that really separates them from the pack.
And they are pouring fuel on that fire with a really aggressive but super strategic expansion plan. Just look at this timeline. The pace is relentless. They're adding new ships left and right, and they're making smart moves into new high-demand markets like India. Their first voyages there sold out almost instantly.
When you look at how they're spending their money, their strategy is crystal clear. It's all about one thing: growth. Every single dollar is going back into the business. They're sitting on a huge pile of cash, $2.6 billion, and they have new ships locked in for almost a decade. So if you're an investor looking for a quick dividend or a stock buyback, well, this isn't the place. They're playing the long game here.
All right, we've seen the great numbers, we've seen the one thing that's making the market nervous, and we've seen the long-term game plan. So let's put it all together and make the call. This is our take on Viking.
Now, before I give you our final rating, I really want to hammer this point home. Let's make sure we're all on the same page about this term, pricing cadence. Again, it's not just that prices are going up, it's about the pace of those increases. And for Wall Street, a slowdown here is kind of like a yellow warning light on the dashboard. It might signal that pricing power is hitting a ceiling.
So this really brings us to the two competing stories for Viking right now, the bull case versus the bear case. The bulls are looking at this and saying, look, the demand is off the charts, and they are executing perfectly. What's not to love? But the bears, they're looking a little further down the road. They're worried that all this new capacity they're adding, combined with that slowing price momentum, well, that could eventually put a squeeze on their profits.
So after weighing all of that, where do we come out? What's the call? Our rating on Viking is market perform. Look, there's no question this is a top-tier company. They are running the business beautifully. But that intense focus from the market on what happens with pricing in 2026, it just creates this perfectly balanced tug-of-war between risk and reward. And because of that, we expect the stock to perform pretty much in line with the rest of the market, at least for now.
All right, and we always have to say it, this explainer is for informational purposes only. It is not financial advice. Thanks for tuning in.